Hey folks, it's Mr. Portland Landlord here. If you've been doing this as long as I have, you know the Portland metro economy feels a lot like one of those classic Oregon rainstorms. It starts strong, pours for a while, then you're left wondering if the sun is ever coming back. Well, grab a cup of coffee or something stronger, because we're diving into the last 10 years of our local economy, what the latest headlines mean for us as landlords and investors, and where things might be headed. I'll keep it real, practical, and sprinkle in a little landlord humor. Because if we can't laugh at a market that's had more twists than a bad lease dispute, what's the point? Let's start with the big picture from the last decade. From roughly 2016 to 2019, the Portland metro was humming. Tech, semiconductors, big companies like Nike, and a hot housing market drove solid GDP growth, often beating the national average. Employment climbed, population grew with folks chasing that Portlandia lifestyle, and rental demand was sky high. Multifamily construction boomed, rents climbed steadily, and property values felt like they were on a permanent up escalator. Then COVID hit like a surprise 30-day notice. Remote work flipped the script, downtown emptied out, and we saw outmigration from Multnomah County as higher earners headed to the suburbs or out of state. By 2023 and 2024, we were still recovering in fits and starts. But the shine had definitely worn off. Fast forward to 2025 and 2026, and the Portland Metro Chamber's latest State of the Economy report hits like a cold splash of Willamette River water. We lost 8,800 jobs last year, fourth worst among major U.S. metros, while the nation kept growing. Unemployment ticked up around 5%, population growth stalled, and our real estate attractiveness ranking, a dismal 80th out of the top markets. Multifamily housing permits hit a 15-year low at just 656 units in 2025. Ouch. High office vacancies are still hovering near 32% downtown, though there's a tiny dip to 31.9% in early 2026. That's a glimmer of hope. Foot traffic has improved, but still needs another decade to hit pre-pandemic levels. These are structural challenges, not just a temporary hiccup. Now let's talk rentals, the part that hits closest to home for us. The rent versus buy gap is narrowing, which is one bright spot from recent Redfin data. Home buyers here needed about $144,000 in annual income to afford the median $545,000 home as of late 2025, down from higher peaks, thanks to mortgage rates easing to around 6.1%. Rents ticked up slightly to where the typical rental requires about $71,700 in income. That's still a premium for buying, but the gap shrank in Portland and most metros. For landlords, this means some tenants who were on the fence might finally jump to ownership, potentially softening rental demand in the middle market. But it also creates opportunities. More move-outs could mean turnover, and in a softer market, strong screening and smart concessions become your best friends. One issue that keeps coming up in every conversation about Portland's economic recovery is the persistent challenge of homelessness intertwined with untreated drug use and addiction. This isn't abstract policy talk. It directly affects our properties, our tenants, and the broader metro economy in ways that make downtown revitalization feel like pushing a shopping cart uphill in the rain. The latest 2025 point-in-time count showed the Tri-County area with around 12,034 people experiencing homelessness, a 61% jump from 2023. Statewide, it topped 27,000, despite adding over 1,500 new overnight shelter beds and spending more than $1.4 billion regionally since 2021. Unsheltered numbers remain stubbornly high, with estimates around 9,000 in Multnomah County alone. Public drug use, especially fentanyl and meth, has become more visible, contributing to what economists call an urban doom loop. Safety concerns deter businesses and higher-income residents, which slows job growth and investment, which in turn makes it harder to fund solutions. For us as residential landlords, the impacts are concrete and costly. The recent Pearl District lawsuit by Pearl District Apartments LLC against the city and Salvation Army is a textbook example. They own the Oro Apartments, near a new 200-bed overnight shelter, and are claiming $6 million in damages from lost rental income, skyrocketing operating expenses, diminished property values, open drug use, trespass, litter, public disorder, and more. The owner even pitched a tent at City Hall to protest. Mayor Wilson himself reportedly acknowledged the building could be the tip of the spear for disruption. That's not just one property owner's headache. It's a warning for anyone with assets near high-impact areas. From our Paroa helpline logs, we've seen a noticeable uptick in calls about tenant and neighborhood issues tied to nearby encampments or untreated addiction, increased property damage from trespassers, higher turnover as stable tenants bail for quieter neighborhoods, more maintenance and security costs, and questions about fair housing, compliant ways to address lease violations. Our classes emphasize practical steps here: thorough, compliant applicant screening with income, references, and criminal checks within Portland's rules, clear lease language on guest policies and illegal activity, and documenting issues early for termination processes if needed. It's not about stigma. It's about protecting your investment while treating people fairly. Managing rentals would be a lot easier if the biggest drama was just a noisy neighbor, instead of figuring out how to navigate an unplanned open-air market affecting your building's curb appeal.
Why join www.paroa.org? In a market full of economic curveballs like job losses, policy proposals, and neighborhood challenges tied to homelessness and addiction, Paroa gives you the tools, landlord forms, education, and network to stay ahead, whether it's compliance screening or advocacy that protects your investments. Members get real-world strategies that turn challenges into opportunities.
Back to the outlook. On the treatment side, Oregon recriminalized low-level drug possession after Measure 110's experiment, and there's been some progress adding behavioral health and sobering beds. But gaps remain. Wait lists for residential treatment, workforce shortages, and coordination issues mean too many folks cycle back to the streets. The city is also exploring a vacancy fee on long empty commercial and residential spaces. Councilors want to study it to push landlords to fill storefronts and units faster. Landlords like Jim Mark call it a terrible idea that could scare off investment when we're already offering concessions and remodeling to attract tenants. Studies from other cities show these taxes rarely slash vacancies dramatically and can just shift costs to renters. Mayor Keith Wilson's Central City Roundtable, co-chaired with ZGF's Nolan Linehart, is pushing 3 big goals plus one: restore pre-pandemic foot traffic, fill vacancies including net absorption, add 2,500 housing units by 2030, and activate storefronts with grants, tax exemptions, and office-to-residential conversions. Early wins include companies like PwC and Bank of America expanding downtown, plus a matching fund for tenant renovations. Foot traffic hit summer highs not seen since before the pandemic. Optimistic? Absolutely. Realistic? It'll take real execution on safety, streamlined permitting, and job growth in traded sectors, especially tackling the homelessness and addiction piece head-on. The chamber calls it a new normal. Hybrid work isn't going away, so mixed use and livability have to lead. If these efforts click, we could see stabilized rents, fewer concessions, and stronger property values by 2028 to 2030. If not, expect continued pressure on downtown residential and retail, with suburban and central Oregon pockets faring better. Clark County, for example, has outperformed on employment. For us as landlords and investors, here's the actionable takeaway. First, double down on best practices from our Paroa classes. Thorough, compliant tenant screening is non-negotiable. When economic uncertainty and neighborhood disorder make financial stability a bigger risk, use our landlord forms and templates. They're gold for staying legal and fair. Second, diversify. Mix long-term residential with short-term vacation rentals in Central Oregon if you can. Third, maintain aggressively. Great curb appeal and quick repairs keep good tenants longer in a competitive market. Fourth, advocate. Join us at Paroa to push back on policies like vacancy fees or shelter placements that punish owners instead of solving root issues. What do you think? Will Portland turn the corner by 2030? Drop your thoughts in the comments below. Looking ahead, the Portland metro economy isn't doomed, but it's at an inflection point. Structural headwinds meet real opportunities. If the roundtable delivers on housing, vibrancy, and treatment pathways, and we keep building jobs, we could turn the corner by the end of the decade. If not, expect slower growth, more concessions, and continued out-migration pressure. Either way, informed landlords who screen smart, manage efficiently, and stay networked will come out ahead. In the end, the last decade taught us resilience, and the next one will reward those who plan ahead. Stay sharp out there. Hey, if you're a Portland area landlord, come join the community over at www.paroa.org. We've got education, forms, networking, and we fight for your rights at the legislature. And for owners in the Portland Metro or Central Oregon looking for hassle-free management, check out the pros at www.nwrpm.com.